Hi, my name is Darren Joseph from HTJ.tax, and we're the team that seeks to demystify that sometimes confusing world of international tax. And today, I just wanted to share some thoughts following a conversation that I had with an important client. So the purpose of this video is to talk about the increasing trend or the increasing focus from governments across the world to targeting and taxing private wealth. So wealth held by individuals, wealth held by families, as opposed to wealth held or earnings generated by corporations. So this is not a conspiracy theory. This is a reality. And why is this so? Here's my opinion as to why this is indeed the case. 3 factors I want to call out. First, there's the weakening corporate tax base. What does that mean? So international competition, certain reforms have diminished traditional revenue streams. 2, rising wealth concentration. A small segment of the population, the so-called 1%, is perceived by the media to hold a growing share of global wealth. And for those who know me and who know and with whom I've had conversations, you know I'm a big fan of Thomas Piketty, the French genius as I call him, who did his PhD at London School of Economics. And he's done a wealth of research, in fact verified that reality, that there is an increasing concentration of wealth across the world. Western world in particular, because that's where we're functioning, but across the world in general. And then the third factor I want to call out is political evolution. What do I mean by that? Is that corporations have become quite adept at what we call lobbying, or let's say influencing government from a policy point of view. In other words, to ensure that their wealth and their income isn't given too much focus as governments try to raise greater revenue. So in other words, don't look at us as corporations, look at individuals, look in the other direction. Okay, so now that we've established that governments across the world are focusing on private wealth, how are they doing that? So what we're saying is that there are 3 ways in which this is happening. Firstly, wealth taxes, gift taxes on real estate and local investments. That's number 1. And the whole focus on real estate taxation, we're actually going to discuss that in another series of videos we're going to do with Mark Morris. 2, a broader definition of personal income. We're going to see many jurisdictions, and we're seeing it already, kind of widening the definition of personal income to include unrealized capital gains. That's number 2 I want you to keep an eye on. And number 3 will be the targeting of so-called nomads. This is higher net worth individuals who may be privileged enough to have homes in multiple jurisdictions or have the ability to move to multiple jurisdictions because they have other passports and residencies and they're enjoying other options. So in terms of the targeting of so-called nomads, I guess a recent case, at least in Southern Europe, has been the case of Shakira, and the idea of when someone has homes in multiple jurisdictions or someone is internationally mobile, how exactly do you tax them? And it's widened that conversation. It's really creating a narrative around that. And in line with that, we are seeing jurisdictions responding. And 5 ways in which we see jurisdictions responding are as follows. Firstly, substance-based residence criteria. And what we mean by that, we talk about center of life tests that are already the norm in many European countries and also other countries in the Anglosphere. So for example, Canada, Australia, and so on. 2, deemed residence tests. 3, enhanced international data sharing mechanisms. And we have a series of videos where we talk about the FATCA, CRS, COF, automatic exchange of information when it comes to real estate rental income. 4, questioning the validity of tax residence certificates from countries where the 183-day rule does not apply. So there are certain jurisdictions that will give you a tax residence certificate after 30, 60, 90 days. Anything fewer than 183 days, it may be challenged by some of the other jurisdictions. And number 5, exit taxes on individuals changing residence. So what are the implications for high net worth individuals? I propose that there are 3 implications or 3 strategies that you want to consider as a high net worth individual or someone who advises high net worth individuals. Firstly, we need to accept that we live in an evolving landscape. Things are changing, and sometimes I'm on calls with my clients' other advisors, And sometimes the advisors are very much stuck in the old way of doing things, and they don't understand that structures that were fit for purpose a year or two or maybe 10 years ago will no longer work in this evolving landscape. We have to accept that things are changing, and we need to stay on top of these changes. Number two, substance over form, like we say in basic accounting. Unless there's a genuine commercial or some other reason for a structure, if a structure only exists for a tax benefit, know that it will be challenged. Those days are gone. Three, prioritize transparency and compliance. I was at dinner with another advisor a few nights ago, and I find that sometimes my other advisors are stuck in the, well, this we can hide mentality. The days of trying to hide, they're just gone. They no longer exist. It's no longer worth playing that game, that hide and seek game. Especially when it involves leveraging very lowbrow jurisdictions that are already on several blacklists and that have a reputation that is less than savory. The last thing you want to do is raise alarm bells with the tax authorities with questionable structures. So yeah, while it may be technically legal, understand that increasingly it may face challenges, especially as it ties back to what I said previously. If there's not a genuine reason, aside from a tax benefit, for having any such structure.